And in our top business story, the UAE's non-oil private sector regained some growth momentum in November, reversing a slowing trend seen in each of the prior 3 months. A robust expansion of new work was a key factor behind improving business conditions. Stronger demand also contributed to faster job creation and a marked rise in purchasing activity. Output also increased sharply, although at a slightly weaker pace than in October. On the price front, charges continued to fall in spite of higher purchasing costs, with some panelists indicating that they had offered discounts as part of sales initiatives. The headline seasonally adjusted UAE Purchasing Managers Index, which is a composite indicator designed to give an accurate overview of operating conditions in the non-oil private sector economy, rose for the first time in 4 months during November. At 54.2, up from October's 6-month low of 53.3, the latest reading was above the 2016 average of 53.8 and consistent with a robust improvement in business conditions. Data showed that growth of new business was central to the rise in the headline index. The rate of expansion picked up from the relatively subdued pace seen in the preceding 2 months. The surveyed firms attributed higher new orders to successful marketing initiatives, including price discounting. Companies lowered their charges on average for the 13th straight month. The rise in total new work was hampered by another fall in new orders from abroad during November. Meanwhile, output continued to increase substantially, though slowing slightly since October. Jobs growth also accelerated to a 4-month high, with a number of businesses requiring extra manpower in order to cater for new projects. As UAE China bilateral trade is expected to reach $80 billion in the next 2 years, and China is ranked as Dubai's largest and one of the UAE's biggest trading partners, officials attending the Hangzhou Dubai City Promotion Conference in Dubai highlighted the need to modernize historic trade and cultural links between both countries. While stating that the UAE is a key trade hub for China, as it provides an important regional base for over 4,200 Chinese companies and private businesses, Chinese officials highlighted that there is a need to bridge the gap that exists between China and the Arab world, as both countries can take advantage of their historic trade links in many key sectors, including trade, tourism, finance, and technology. During the conference, it was revealed that Hangzhou, the capital of Zhejiang province in China, with its close proximity to Shanghai, is increasingly recognized as a key destination for investment, as it allows companies in the UAE and the wider Arab world the opportunity to invest and market their services. The UAE's total GDP is expected to reach 1.8 trillion dirhams by the end of this year, and 70% of its GDP is not dependent on oil. Chinese officials highlighted that Hangzhou can become a key investment destination for Dubai, as it's seen as a hub for manufacturing energy-efficient technologies in China.
The history is deep enough where the continuity between cultural exchange is very strong. The trade continues, and what we're seeing now is an amplification and deepening of those relationships. So, for example, and the small part that we have played, DIFC, is to enable the deepening of that by providing access to financing. So you can't have trade without financing, and being able to provide a great platform for the biggest 4 Chinese banks to fund and finance their state-owned enterprises into the region and into Africa is one way of deepening those already really good relationships.
I believe that Dubai is a very open country, and it's a very good policy, like there's no tax in Dubai, and also especially there's no foreign exchange control, and for the visa they have the very flexible to get the visas, and we found that like each year there's hundreds of Chinese companies coming to Dubai. Now currently in Jebel Free Zone they have 7,000 companies, and within these 7,000 there's around 300 Chinese companies already registered in Dubai. I believe totally in Dubai the number should be much more than this number, and I suggest that all Chinese companies can look into Dubai and the policy, the open policy and everything. I believe it's a very good city for investment.
As more and more Chinese companies are looking to invest in the UAE and Dubai in particular, officials representing the DIFC, Dubai Trade and Jebel Ali Free Zone, highlighted that UAE is a key partner and supporter for China and its One Belt, One Road policy. And with initiatives like visa on arrival for China, they intend to attract more investment from Chinese companies in the UAE.
Look, South-South is a broad corridor, but the biggest piece of that corridor are the trade investment flows to and from China, being the largest economy, second largest economy in the world. So what One Belt, One Road does is it amplifies and focuses the trade investment flows from that region into this region. And for us, for DIFC, that is very advantageous because our strategy focuses precisely on that corridor. The Chinese element is a huge piece of that corridor.
Dubai financial market listed Deyaar Development is offering guaranteed returns of 14% for a period of 2 years or 7% per annum on its under construction project in Business Bay. The returns are being offered to investors buying into the Atria, a 30-story residential tower, and 4-star serviced apartment tower to be operated by hospitality brand Millennium and Copthorne. Deyaar cited a range of other benefits, such as stays for up to 20 nights annually in serviced apartments, reduced hotel room rates for friends and family, and discounts for dining at restaurants. CEO Saeed Al-Khatami was quoted in a local report stating that the package offers investors the opportunity to own a serviced apartment in one of Dubai's most cosmopolitan quarters, with 14% guaranteed returns over 2 years and access to a range of luxury benefits. The Atria, which will be completed in the fourth quarter of 2017, overlooks the newly opened Dubai Water Canal. The hotel tower has 347 serviced apartments, while the adjoining residential tower has 219 apartments. And in other company-related news, UAE-based operator Rotana has announced plans to open 7 new hotels in Dubai, 4 hotels in the capital Abu Dhabi, and 1 in Ras Al Khaimah by the end of 2020. 6 of the upcoming properties will be 5-star hotels, with the remaining properties comprising of a mix of 4- and 3-star hotels and hotel apartments. On completion, the new hotels will add 4,360 keys to Rotana's existing inventory, taking its portfolio in the UAE to 44 properties, including 21 in Dubai and 17 in Abu Dhabi, hiking Rotana's total room inventory to 11,782. The total value of the 12 upcoming properties managed by Rotana in the UAE is estimated at $1.7 billion. Amar Kaddouri, president and CEO of Rotana, was quoted stating that Rotana already has a significant presence in the capital, and strengthening our portfolio with an additional 4 properties will allow us to further contribute to and capitalize on Abu Dhabi's expanding tourism and hospitality sector, adding that in Dubai, the 7 upcoming properties will go a long way towards meeting the demand increase anticipated in the run-up to Expo 2020. Despite the challenging economic environment, the outlook for the hospitality sector in Dubai and Abu Dhabi remains positive. In previous UAE Real Estate 2016 mid-year market reviews, global consultancy firms listed the mid to long-term outlook for the hospitality sector in Dubai and Abu Dhabi as positive, citing the opening of theme parks and new tourist attractions among the main factors driving demand.